They told you the bull market was over. They told you gold at 5,600 was a bubble. They told you to take profits, to get out, to panic. And yesterday, when gold crashed $500 in 30 minutes, they told you this was the end. But while you were staring at the red candles, wondering if you should sell, you missed the smoking gun. You missed the evidence. You missed the crime scene. We warned you about the war volatility. We told you the Iran strike window was open. We told you the dollar was collapsing. We told you Trump endorsed the weak dollar policy. But what happened yesterday? That wasn't war. That wasn't geopolitics. That was a forced execution. That was a coordinated liquidation event triggered by a massive margin call cascade that started in Microsoft and ended with $500 swings in gold. If you didn't sell a single ounce when silver hit $107 yesterday, you are a legend. You are the diamond hands that the manipulators fear. Hit that subscribe button right now. Turn on notifications. Because what I'm about to show you is the complete forensic breakdown of who crashed the market, why they did it, how they did it, and why it just backfired spectacularly. We are going to expose the crime scene. Do it now. Let me start with the timeline, because the correlation between what happened in the equity market and what happened in precious metals is not a coincidence. T is the smoking gun. 9:30 a.m. Eastern Time, January 29th. The Nasdaq opens. Microsoft, ticker MSFT, immediately plunges 7%. By the close, Microsoft is down 11.91%. That is the worst single day for Microsoft since March 2020, the COVID crash. The market capitalization wipeout, $357 billion. That is the second largest single day loss in market history. $357 billion evaporated in one session. Now watch what happens to gold. 9:45 to 10:30 a.m. Eastern. Gold, which had touched an intraday high near $5,597 per ounce in Asian and early European trading, suddenly plummets $490 in 30 minutes. 30 minutes. It drops to a low of $5,104. That is a 9.4% swing in half an hour. Silver, exact same pattern. It peaked at $121.64. It crashed to $107. Then by 10:30 a.m. to 4 p.m., gold recovered to close near $5,379, down only 0.76% on the session. Silver followed the identical V-shape. By the time the market closed Thursday, it had ripped back to 115. So let me ask you a question. If gold is responding to geopolitical risk, if gold is responding to inflation, if gold is responding to dollar weakness, why did it crash $500 in 30 minutes on the exact same timeline that Microsoft crashed? The answer is simple. Cross-asset margin call cascade. Multiple sources have now validated the forced selling narrative. Let me read you the exact quote from the research. Hedge funds geared to rising tech stocks have been forced to liquidate long positions. And these are often the same players in the managed money category in COMEX gold and silver contracts. Let me read you another one. Investors unable to meet margin calls had to sell what was liquid. Gold hit a record around $5,602 per ounce before dropping back toward $5,100. When an asset has just run that far that fast, a lot of the safe haven demand is already in the price. Once the music stops, the first job is to reduce risk and clean up leverage. Here's the mechanism. Tech-heavy hedge funds were long. Microsoft, long ServiceNow, which also dropped 11.4%, long cloud stocks across the board. When those positions collapsed, they faced margin calls. Their prime broker said, "You need to post more collateral right now or we liquidate your positions." What did they do? They simultaneously dumped their most liquid holdings, including gold futures, to meet those collateral requirements. This cross-asset contagion explains why Bitcoin also fell 5% to $82,000 to $85,000 on the same day. This is not gold responding to fundamentals. This is gold getting used as an ATM by hedge funds scrambling to cover their tech losses. And the victims? Retail investors who saw the $500 drop and thought the bull market was over. Now let me explain why it dropped so fast. Because a $500 move in 30 minutes is not normal selling pressure. That is a liquidity vacuum. That is what happens when the market makers walk away. Saxo Bank's head of commodity strategy, Ole Hansen, provided the clearest explanation for the flash crash's severity. He said, and I want you to listen to this very carefully, "The problem is volatility feeding on itself. As price swings intensify, liquidity thins. Banks and market makers struggle to warehouse risk, especially as their lifeline, the basis between physical and futures, narrows. When their willingness to quote prices in size fades, liquidity deteriorates and volatility blows out. Let me translate that for you. Market makers abandon their posts. Unlike equity markets where designated liquidity providers have obligations, commodity futures rely on voluntary market making by bullion banks. When volatility spiked above the 90 RSI threshold, the relative strength index, these banks, already constrained by Basel III capital rules, simultaneously widened bid-ask spreads and reduced position sizes. Simon Biddle, head of precious metals at broker Tullett Prebon, confirmed this. He said, "Banks don't have infinite balance sheets to trade precious metals. Trading volumes have decreased as they are taking less risk. So here's what happened mechanically. When market makers withdraw, number one, bid-ask spreads explode from 50 cents to $5 plus per ounce. Number two, order book depth evaporates. Those typical 100-lot bids that are always sitting there, they vanish. Number three, stop-loss cascades accelerate. Sell orders execute at progressively lower prices with no offsetting buy interest. This created a liquidity air pocket between 5,500 and 5,100. And that is precisely where the crash occurred. The banks walked away. They pulled their bids. They let it crash. They wanted to flush you out. They wanted to trigger your stop losses. They wanted you to panic sell at 5,100 so they could accumulate at a discount. But there's another layer to this. And this is the part that makes me furious. In the weeks leading up to yesterday's crash, major futures exchanges globally raised margin requirements in response to unprecedented volatility. Let me show you the timeline. Look at the timeline. On January 13th, CME changed the rules to make trading more expensive. Then on January 28th, they hiked silver margins to 11%. In Shanghai, they panicked and hiked margins 3 times in 10 days, hitting 20% today. They made it expensive to be long exactly when they knew you would be leveraged. Do you see what's happening? Rising margins created a self-reinforcing liquidation loop. Let me walk you through the death spiral. Step 1. Exchanges raise margins, so leveraged longs must post more collateral. Step 2. Margin calls trigger forced selling, so prices fall. Step 3. Falling prices trigger stop losses, so there's more selling. Step 4. Market makers withdraw, so liquidity vanishes. Step 5. Price gaps accelerate, and then you go back to step 1 and repeat. One analyst described it as industrial silver producers also being hit by margin calls on futures hedges, making it increasingly painful to maintain protection against future production. This meant both speculators and commercial hedgers were forced sellers simultaneously. That is a rare and toxic combination. So let me summarize the crime. The exchanges raised margins to force liquidations. Microsoft crashed and triggered hedge fund margin calls. Hedge funds dumped gold and silver to raise cash. Market makers pulled their bids to accelerate the crash. Stop losses cascaded. And retail investors who bought gold at 5,400 woke up to see 5,100 and thought the world was ending. But here's the beautiful part. The trap failed. Let me show you the recovery. Gold. Panic low yesterday, 5,100. Current price Friday morning, 5,381. Recovery percentage, 5.5%. Distance from the all-time high of 5,597, only 3.8%. Silver, panic low, 107. Current price. Friday morning, 111.03. Recovery, 3.8%. Distance from the all-time high of 121.64, 8.7%. The recovery's speed and strength indicate bargain hunting demand absorbed the entire liquidation wave. Let me read you the quote. After the price of gold plummeted by nearly $500, bargain hunters increased their buying activity, helping the price of gold recover. And who were the bargain hunters? The physical buyers. India. Gold imports are expected to decline due to high prices dampening jewelry demand, but investment-grade bar and coin demand surged 70% year-over-year in Q1 2026. China. Spot gold switched from a discount to a $3 premium over the London benchmark after the price correction, signaling retail demand remains robust. ETF flows. Even on gold's worst single-day decline in 12 years, North American gold ETFs recorded inflows of $334 million, 2.3 tons. Not outflows, inflows. This is the telltale sign of a liquidation-driven dip, not a demand collapse. Institutional buyers distinguish between technical selling, which is short-term noise, and fundamental value, which is long-term signal. They saw 5,100 and they bought. They saw 107 and they bought. And by the time the retail panic sellers woke up, the price was already back at 5,300. If this was a real crash, if the fundamentals had changed, if demand had collapsed, we would still be down. We would be testing 5,000. We would be testing 4,800, but we're not. We're at 5,381. The physical buyers in India and China stepped in and bought everything the hedge funds dumped. Did you buy the dip or did you freeze? Be honest with me in the comments. Type I bought if you added to your position when silver hit 107. Type I held if you didn't sell a single ounce. Let the bankers who orchestrated this crash know that they didn't get your silver. They didn't shake you out. You held through the manipulation. Do it now. Now let me explain why the fundamental thesis remains completely intact. Because despite yesterday's violence, nothing has changed. The demand pillars that propelled gold 24% higher in January are all still active. Number one, central bank buying, averaging 60 tons per month according to Goldman Sachs estimates. Number two, ETF inflows. North American funds added 801 metric tons in 2025, the highest since 2020. Number three, dollar weakness. The dollar index is at four-year lows. The Fed is maintaining rates at 3.5 to 3.75%. Real yields are still negative. Number four, geopolitical risk, Iran tensions, Ukraine conflict, Trump tariff threats. Number five, fiscal concerns. U.S. debt at $38 trillion. Japan's bond yields at 30-year highs. What changed on Thursday? None of these, only the price, temporarily. Standard Chartered Bank's commodity team views the flash crash as, and I quote, the market's mid-air refueling. Short-term corrections help deflate speculative bubbles, offering opportunities for medium to long-term investors to increase their holdings. Even skeptical analysts acknowledge the rally's structural foundation. Citi maintains its $150 per ounce silver target within 3 months. Deutsche Bank projects gold could exceed $6,000 in 2026 amid the dollar's decline. So, yesterday's crash was a perfect storm of mechanical selling, not a repudiation of gold's safe haven status. Let me list the components. Number one, the trigger. Microsoft's $357 billion wipeout forced hedge fund deleveraging. Number two, the amplifier. Exchange margin hikes, compressed leverage longs. Number three, the accelerant. Market makers withdrew, creating a liquidity vacuum. Number four, the result. $490 intraday swing, erasing $3.4 trillion in notional gold value. But here's what they didn't count on. They didn't count on the physical buyers being ready. They didn't count on the institutional buyers having limit orders at 5,200. They didn't count on the ETF flows being positive even on the worst day in 12 years. They engineered the crash. The crash failed. And now they're stuck watching gold recover while the fundamentals that drove it to 5,600 are still in place. And speaking of fundamentals, let me tell you about the weekend catalyst that nobody's talking about. Tomorrow, Saturday, January 31st, is the U.S. government shutdown deadline. And the probability of a shutdown has now spiked to levels that should terrify anyone holding dollars. Polymarket. 67% chance of a shutdown with over $20.6 million in trade volume. Kalshi. 65 to 75% chance with over $16.5 million in trade volume. NS3 AI. 78% probability. Why does this matter for gold? Historical precedent shows government shutdowns consistently boost precious metals. Let me read you the exact quote from the research. The likelihood of a U.S. government shutdown by January 31st has surged to approximately 78%, prompting investors to turn to safe haven assets such as gold and silver. Goldman Sachs raised its December 2026 gold price forecast from 4,900 to 5,400, specifically citing fiscal brinkmanship, tariff uncertainty, and geopolitical tension. Independent analyst Ross Norman expects a high of $6,400. So think about the setup for Monday morning. The government could be shut down. The Iran strike window is still open through February 1st. The dollar is at 4-year lows. Trump is on record saying he thinks the weak dollar is great. The Fed is paralyzed with a 10-2 vote split. Powell's replacement is going to be announced soon. Probably Rick Reeder from BlackRock, who is explicitly dovish. Oil is at 4-month highs on Iran tensions. And gold just proved yesterday that even a $500 flash crash can't keep it down for more than a few hours. For investors who missed gold's run from 4,300 to 5,600, yesterday's crash created a rare re-entry window. The support level has been confirmed at 5,200. That held as the key technical support throughout Friday's Asian session. The RSI cooldown. The relative strength index, which had reached overbought levels above 90, has now reset to a healthier mid-70s range. In physical premium resurgence, Chinese and Indian buyers are paying premiums over spot for the first time in weeks, indicating stockpiling at perceived discounts. So let me give you the scenarios for what happens next. The weekend brings two critical catalysts, and depending on how they play out, we're either consolidating or we're exploding higher. Bearish scenario, and I'm giving this low probability, government shutdown gets averted, the dollar rallies, gold consolidates in the 5,200 to 5,400 range. Further tech weakness triggers a second wave of cross-asset liquidations. If that happens, you get another dip. You get another buying opportunity. But I don't think this happens. Bullish scenario, and this is the consensus view. Shutdown occurs. Flight to safety accelerates. Gold retests 5,600 plus by next week. Physical buyers exhaust dip supply. Backwardation develops in the futures curve, meaning near-term contracts trade at a premium to longer-dated contracts, which is a massive bullish signal. The VIX, the volatility index, sustains above 16. Equity investors rotate from stocks to hard assets. Here's the playbook depending on where you are. If you're a holder, yesterday was noise, not signal. The 24% January gain remains intact. Use any weekend weakness to add exposure in tranches. Don't go all in at once, but add on dips. If you're a sideline buyer who's been waiting for an entry, the 5,200 to 5,350 range represents value relative to the 5,600 overshoot. Physical premiums in China, plus $3, and India confirm this assessment. If you're a trader, watch the 5,200 support and the 5,500 resistance. A Friday close above 5,400 would set up a Monday gap higher if shutdown headlines accelerate over the weekend. But here's what I want you to understand. Yesterday's crash was designed to scare you. It was designed to make you think the bull market was over. It was designed to trigger your stop losses and force you to sell at the worst possible price. The exchanges raised margins to create forced liquidations. Microsoft's crash gave them the perfect cover story. The market makers pulled their bids to accelerate the cascade, and they thought you would panic, but you didn't. The physical buyers in Shanghai and Hong Kong lined up for hours to buy gold bars. The ETF investors put $334 million into gold funds on the worst day in 12 years. The Indian retail buyers paid premiums over spot to accumulate. And the institutional buyers who understand that gold at 5,100 with the dollar collapsing and war tensions mounting and a government shutdown coming is an absolute gift, they stepped in with limit orders and bought everything the hedge fund sold. The trap failed, the manipulators lost, and now we're sitting at 5,381 on a Friday morning with a 78% chance of a government shutdown tomorrow and an Iran strike window that's still open, and a Federal Reserve that's politically captured, and a president who explicitly wants a weak dollar. The crash is over. The recovery is complete. The fundamentals are intact. The weekend could bring the shutdown catalyst. Monday could be the biggest gap up in history. Are you ready? Subscribe to this channel right now and turn on the notification bell. Because if the government shuts down this weekend, if the Iran strike happens, if gold gaps to 5,800 on Monday morning, we will be live breaking it down in real time. You need to be here for it, and drop a comment below. Tell me, did you buy the dip at 5,100? Did you hold through the crash, or did you panic? Be honest. This community is built on transparency. We learn from each other. And the more the manipulators see that their tactics don't work on us, the weaker they become. The crime scene has been exposed. Microsoft crashed. Hedge funds got margin calls. They dumped gold and silver. Market makers walked away. The price collapsed $500 in 30 minutes, and then the physical buyers stepped in and bought everything. The V-shaped recovery proves the thesis. The fundamentals haven't changed. The war is still coming. The shutdown is still coming. The dollar is still collapsing. And gold is still going higher. They crashed it, and it backfired. Stay sharp. I'll see you in the comments. And I'll see you on Monday when we break down what happens after the shutdown. Don't miss it.